Right, I assume that you have read through the scenario. Now, the parents sell inventory to the subsidiary, therefore this will not have an effect on the analysis of owner's equity. Now they indicate to us that the subsidiary purchased all of its inventory cash from the parent at a gross profit percentage of 20%, and then there was still inventory on hand at the end of 20.1230,000. Then the inventory on hand at the end of 2012 was written down to net realizable value of 26,000. Total sales of the parent to the subsidiary for 2012 amounted to 80,000. Current tax rate 29%, and we need to prepare the pro forma journal entries relating to the sale of inventory for the year ended 31 December 20.12 and 20.13. Look at this, 20.12 and 20.13. Now, my first step, as always, is I prefer to ensure that I understand what is the journals in the separate records. Then I look at the effect in terms of my group to be able to identify my journals. What do I need to do to correct my group? Now, when I think about my group, I think about my trial balances, my TBs, right? Now, then what is important? If it is straightforward, I do not make use of a timeline. But if it gets complicated, I prefer to make use of my timelines. I need to prepare the journals for 2012 as well as 2013. Therefore, this will be my step number 3 if it's a complicated transaction. Now, my step number 4 will be to include my elimination journals. Now, let me just recap. Step 1, understand the journals in the separate records. Understand the effect on my group. If it's a complicated transaction, include a trial timeline. And then I prefer my elimination journals. Right. Now, when we look at the separate records, our parent sell to the subsidiary. Therefore, in the separate records of our parent will debit cost of sales, this will increase the seller, credit inventory, decrease, debit bank, and credit sales, increase. In the buyer's records, our buyer will debit inventory, increase, credit, creditor, or bank, in the scenario bank, and they've indicated to us that there is a write down. If there's a write down, our inventory will decrease and debit a write off in our profit and loss. Now, if you think about this, what will the effect on our group be? From the seller's point of view, the seller will recognize a profit. If you think about your trial balance, the seller will recognize a profit in profit and loss, which is unrealized. Remember, the parent and the sub is seen as one entity. In their buyer's records, the buyer will include that unrealized profit in inventory. Therefore, our inventory will be overstated with that profit section. Now, how do we correct this? Number 1, we will then have to take out the profit from the profit and loss from our parent. And number 2, we will have to take out our inventory portion. Now, the section that's a little bit complicated here is the fact that they've written down a portion of the inventory. Therefore, if they've written down a portion of the inventory, we need to identify what is the remaining unrealized. Why unrealized? Because this profit has not yet realized. It will only be profit for the group if they sell this to a third party, someone outside the group. Right. Now, remember, we need to perform the journals for 2012 as well as 2013. Now, when we look at 2012, you will remember they've indicated to us that the sales for this year was 80,000. Therefore, first, we will have to take out the sales transaction, because if we think about our trial balance, the sales and the cost of sales will be pretty skewed. Therefore, so to be able to take this out, we need to eliminate our sales. Debit the sales, this will decrease, and credit cost of sales decrease. We are correcting our revenue and cost of sales. On the profit itself, it will not have an effect. Okay, it will not have an effect on our profit. Right, now, in terms of our amounts, we need to calculate our unrealized profit. They've indicated to us that there's 30,000 inventory on hand times 20%. Therefore, this will be 6,000. However, they've already written off 4,000 of this. Therefore, this will now be remaining 2,000. Now, if you think about this, remember, we've identified that we will have to take out. When you look at the right side of your screen for me, please, we need to take out the profit. We need to take out the inventory. Now, if we take out our inventory decrease on the credit side, and therefore we will have to debit our cost of sales. Our cost of sales will increase. If our cost of sales increase, our gross profit will decrease. Therefore, if we look at our transaction, we debit our cost of sales and we credit our inventory. Now, the tax effect that you always need to remember, please. If our cost of sales increase, this is an expense, our profit will decrease. If our profit decrease, our tax will decrease. If our tax decrease, our tax decrease on the credit side. Therefore, we credit our income tax expense. Now, this journal relates to 20.12, right? But what happens in 20.13? If you think about this, at the end of 20.12, we've debited our cost of sales and we've credited our income tax. This is profit and loss line items, right? We've credited our inventory and we've debited our deferred tax, right? Now, do you agree with me? If we look at these line items, the net effect at the end of 20.12 will be in our profit and loss, and then at the beginning of the 20.13 financial year, this will be included in our retained earnings. Yeah, this will be included in our retained earnings. Therefore, to recognize this transaction, remember, we need to do this again. Why? Because at the end of 20.13, we receive a clean trial balance of our parent plus a clean trial balance of our subsidiary, and we need to correct our opening balance retained earnings to ensure that all of our opening balances of our group agrees to the closing balances of our group. Therefore, for 20.13, we will have to debit our retained earnings, adjusting our retained earnings to assure the consolidated retained earnings at the beginning of 20.13 agrees to our consolidated retained earnings at the end of 20.13. Now, you might ask me, but why do we credit our cost of sales? Okay, now, if we look at inventory, we assume, due to the fact that inventory will be a current asset, that this will be sold within the next 12 months to a third party, therefore outside the group. And then profit on this transaction will realize. Therefore, if you were not to include this one journal, but rather separately, you will still debit your retained earnings and you will credit your inventory to be able to recognize a similar transaction as compared to our transaction for 20.12. Look at this, pretty similar though. Okay? Retained earnings, inventory. And then once the inventory are sold to an outside party, not a party in the group, we will have to debit this line item. Why? Because if we do not do this, this will still be included via that journal entry in our inventory, or not included, but the credit. Right. Therefore, we now debit this to eliminate that credit due to the fact that they've sold this to a third party. Because in the separate records of the subsidiary, which is the buyer, the subsidiary will recognize debit debtors, credit sales, debit cost of sales, and credit our inventory. Therefore, in the separate records, the subsidiary has already decreased the inventory with this sales transaction, and we now need to eliminate this. Right, okay. Now, that's why we'd rather choose to include only one journal entry. But if you want to, you can make use of the two on the right side. Then please remember your tax implication, which will be recognized to your retained earnings. We will credit the retained earnings because prior our income tax expense in our profit and loss were credited. And then when they realize the transaction, we will reverse this journal entry. You see, we will debit our income tax expense and credit our deferred tax. Why? Because this transaction is already included in the separate records of our subsidiary.